Down around 70% from its all-time highs achieved less than a year ago. I've gotten more requests to dive deep into PayPal than any other stock. Let's do it. Welcome back to the channel. My name is Steven Spicer and I think I love you. Seriously, don't tell my wife I said that, and don't worry, she doesn't watch my videos anyway, but what you and I have, it's special. Thank you for all those likes and comments on our last videos where we reviewed Alibaba and Meta, Facebook. I had great conversations with many of you in the comments and heard you loud and clear. You want more analysis videos and you love getting into the nitty-gritty. Well, so do I. And we're gonna get in there real deep today. Specifically, as I said, you asked me to dive into PayPal. Now, before diving into any numbers or attempting any sort of realistic valuation, you need to understand the business. Without that solid understanding first, you're running blind. There's no way you can know what you're doing. There's no way you can know if your valuation makes any sense at all. You'll have no way of knowing how your business compares to others that are out there. You get the idea, I hope. So let's get into it. PayPal was founded in 1998, and that's important because when we do try to determine a fair value, we want to find comparable companies in order to gauge a relative value. There really aren't any that are like PayPal and in a similar business life stage. So keep this in the back of your mind for when we get to that point later on. Now, the next major historical event messing with PayPal's valuation is when it was spun off of eBay in 2015. And we'll touch on the effects of that when we get into the numbers as well. So real quick, what exactly does PayPal do? Well, they were kind of the OG fintech disruptor, and they're well positioned to be able to continue to disrupt, innovate, and improve in that space. Their MO is to connect merchants and consumers in as secure a way as possible. They currently boast that they're doing just that in more than 200 markets around the world. They currently employ more than 30,000 people, boast more than 425 million active accounts, and more than $1.25 trillion in total payment volume over the last 12 months generated from the more than 40,000 payment transactions they process every minute. They're big, and they continue to invest heavily in research and development, as well as expand via acquisitions. Although they have had some great synergies with several of their organic and M&A expansions here, they've also had, as should be expected, a few expensive flops. Most recently, and right toward the beginning of this recent sell-off, was the rumor of PayPal's purchase of social media platform Pinterest for a record, for them, purchase price of $45 billion. After some severe shareholder backlash, bringing into question management's decision-making capabilities, they backed out of that one, but the damage to their reputation might still be part of what is tainting the investing public's opinion of this stock. Regarding the company's organic expansion, 2021 saw a record number of internal products launched, and they seem to be having success with many of these initiatives. Their unique advantageous position as the first mover in this fintech space is undeniable. With their ability to generate massive amounts of cash flow each year and their high R&D budget, they are absolutely in the best position to take advantage of opportunities and trends. That, of course, is still not a guarantee of future success, just an important element to keep in mind when we compare it to others later. PayPal's digital wallet is still the most accepted among its peers across North America and Europe. And its peer-to-peer payment arm, Venmo, continues to dominate the market with 57.5% of that market share, followed by Zelle with 35.6% and Block's Cash App with 30.8%. Also, with their entrance into the rapidly growing buy now, pay later space, they're well positioned to expand market share there as well. I'm sure you get the picture. If it involves moving money in some way online, PayPal has, or will likely attempt to have, their fingers in it. For example, with their new Super App initiative, they've begun allowing customers to pay using a select few cryptocurrencies, although their entry into this space has been with nowhere near the enthusiasm as their rival Block. Also, and this will show up in our bull case scenario at the end, there's been talk of getting into the lucrative brokerage space, just expanding the functionality of PayPal's digital wallet offering. So up until now, what has all this meant for PayPal's financials, their fundamentals? Well, despite all this aggressive expansion over the years, or perhaps because of it, PayPal's balance sheet continues to be robust. They ended last year with a debt-to-equity ratio of 41.6%, which is very healthy, with more than $9.5 billion in cash and short-term investments, which in and of itself is enough to cover all their debt. The company's revenue has continued to do exactly what any business owner would want it to do, go up and to the right. Their payment volume from both PayPal and Venmo continued to reach all-time highs. And by the way, if you're curious about or interested in any of the software I use in my analyses and show in my videos, many of you were asking in the comments last time, there are affiliate links to my favorites, some with exclusive discounts that I've been able to work out for you in the description below. Or feel free to hit me up with any questions about any of this in the comments. Now, despite their growing user base, they were still able to increase their transactions per active account, which of course increased their total number of payment transactions. Venmo will likely see a significant surge as well here in the coming quarters as they continue to find ways to monetize it. Specifically, in the near term, it'll be exciting to see what its integration into the Amazon checkout process will produce. But one of the biggest hangups investors had after their most recent quarterly report was their less impressive account growth, and even worse 2022 guidance. In fact, not only did they significantly miss their expected mark, but they also changed their focus. Management says that instead of focusing on growing their number of net new active users, they plan to focus on engagement in order to extract the most value from each user. I don't disagree with the initiative, but the optics understandably look bad. In fact, following the call, there was a flight to the exits by the so-called sophisticated investors, those managing ETFs, mutual funds, hedge funds, and their ilk. Take heart, however, if you're a PayPal fan, they often get this sort of thing wrong or extend it too far, pushing prices much lower than warranted, creating opportunities for the everyday investor. But if they are still putting downward pressure on the stock, if they're still trying to sell out of their positions en masse, that's not something you want to be competing against, or at least you should be aware of it and its implications before entering any position. Now, with this shift, although their revenue growth has been strong in the past, they're forecasting a rather significant slowdown. So what are some of the biggest headwinds facing PayPal? We've already touched on their slower new user growth. That could be a result of the rapidly increasing intensity of the competition in this space. You have Block, or Square, and SoFi, two young, publicly traded disruptors in this space who are arguably much more nimble due to their smaller size than PayPal. Those companies were founded a decade after PayPal, in 2009 and 2011, respectively. We'll compare a bit to Block when we look at valuations, but they're understandably, due to the earlier stage of a business's lifestyle that they're in, valued much more like a riskier growth stock than PayPal probably should be. Again, file that away for when we get there. We won't use SoFi, however, since they're still loss-making. That makes any sort of comparable valuation rather difficult. There are also a number of private venture-backed companies that pose a threat to market share as well. The Elon Musk-backed Stripe comes to mind. It too was founded in 2009. Although it shares a valuation that's not all too far from PayPal's, because they're private, they're able to keep their revenue and profit figures close to their chest. So there's not much we can do with that from a comp perspective, except acknowledge the threat that they pose to market share. Then you have the older financial players, think Visa and MasterCard, both founded in the 1960s, who are much slower to move, but will be experiencing more and more pressure to cut out the middleman, so to speak, if at all possible. That was the biggest part of the impetus for eBay's separation from PayPal. Take a look at how they spun it.
It's now simpler to get paid on eBay. Your eBay earnings will go directly to your bank account, not your PayPal account.
eBay saw an opportunity to cut PayPal out of the transaction, ultimately increasing their own bottom line, and so they did. Now, I've personally, anecdotally, seen plenty of merchants on their platform not happy about that move, but it does highlight the fact that that is a possibility. A very legitimate way PayPal could ultimately lose market share and revenue. Circling back to the idea of competition and those who might have the power to cut them out or in some other way steal market share, there's Apple and Google Pay competing in a similar capacity in this space. As their competition increases, there is added pressure for PayPal to improve their customer experience. This is, again, anecdotal, but I've seen countless people complaining about their experiences with PayPal, including myself. I don't particularly like when I have to use it. That being said, according to J.D. Power and Associates, PayPal actually ranks relatively high on the merchant side of things. But perhaps that's what this shift in management's focus will bring about, an improvement to their customer experience overall. in order to maximize their retention and ultimately the company's earnings per user. Okay, so how do we value a company like this? Well, before we get into the nitty-gritty of it all, I do have to say that I am a licensed and practicing financial professional, and this is absolutely not financial advice. You'll find a link to the full list of my disclaimers and disclosures in the description below. All right, so back to the valuation question. Well, pretty much any way you slice it from a value perspective, PayPal's current valuation does not look entirely unreasonable. Its current value reflects as undervalued from only a very few metrics. From a growth perspective, on the other hand, compared to all its sector peers and its own history, PayPal does not appear particularly attractive at all. To pile on, obviously from a momentum perspective, PayPal as an investment looks like a terrible idea, unless you like catching falling knives, or more likely you have yet to experience the pain that is trying to catch a falling knife. The technicals will confirm as much here. Once again, if you're interested in any of the tools I use professionally, ask, or just check out the links in the description. Now, from a profitability perspective, PayPal looks extremely attractive. We've already seen they're one of those cash cow companies with very little debt, and it's just a question of how they put that cow to work for them in the future that really matters. Those can be the types of companies that you can feel more comfortable holding long term, that you don't have to stress about too much when they're in your portfolio, as long as they don't change their thrifty ways and start amassing too much debt or something like that, or buying social media platforms like Pinterest or whatever. That being said, PayPal has a terrible recent history of downward revisions, meaning any future estimations of revenue or earnings per share from the company or analysts might need to be taken with a grain of salt. Keep that in the back of your mind as we run our multiples analysis here in a bit. Now, a lot of new investors, when trying to come up with a valuation here, would like to point to where it's been recently, valued at over $300 per share, and think, well, with how strong the balance sheet and profitability are, surely this company has fallen too far. Investors have overcompensated on the downside. But when trying to value what a company, what a stock is worth to you, you have to ignore where it's been, especially when you can point to a relatively elevated valuation in the recent past. Here's what I mean. In June of 2020, PYPL traded with a PE ratio north of 100, and in February 2021, a price to sales ratio greater than 16. Those valuations are objectively high. That PE ratio would have had to have been pricing in a ton of explosive growth potential that I just don't think was ever actually there. More likely it was all just euphoria. And anybody that was telling you to invest back then is at best a risky growth investor and not a value investor. Or at worst, they really have no idea what they're talking about. I personally struggle with some of the modern concepts of what defines a growth investor. I'm fine with growth at a reasonable price, like Peter Lynch used to look for. But I don't like investing my money in something that I struggle to value. If I don't know what it's worth, I don't know what I'm willing to pay for it. I understand I'll miss the boat on some lucrative opportunities as a result of this philosophy, but for me, my process helps me to have more confidence in the investments that I do choose to pursue, no matter what happens. In the global environment, think Ukraine, Russia, or domestically, think inflation and or recession, which I believe will help me achieve even better returns over the long run. Sometimes it's easier to see how a company could grow its earnings into an elevated valuation, and that's fine. But PayPal at 100 plus times earnings, it's not obvious to me, based on my research, where they're going to be able to make that up. That leads me to believe this stock fell victim to, along with so many others, the pandemic stock euphoria. Doesn't mean any of those stocks are bad, just that they were way overvalued due to a euphoria-induced miscalculation as to the lasting impacts of the shutdown. All right, so with that backdrop, we're going to get a little bit more detailed with our valuation on this one, if that's all right with you. First, we're going to get a solid grasp on PayPal's relevant historical financial information and understanding of their valuation multiple history, not just that spike in their more recent history that we just talked about. We'll go similarly deep into a few of those comparable companies we touched on earlier. This will give you a much better idea of where I'm pulling those figures from that we'll use to populate our discounted future earnings model. Believe it or not, it's not just out of thin air. It's based on a comprehensive understanding of the company's past, comps, and the industry as a whole. Then we'll go beyond that earnings model we used for Baba and Meta and run a simple multiples analysis to get a comparative valuation to its comps and its past self. Sound good? That was a lot, I know. But if you stick with me as I take you through all this step by step, I think you're going to feel way more confident about your understanding of PayPal's true value, even if you don't agree with my ultimate valuation figure. That's actually not what's important here. But you'll also, and probably more importantly to my goals here, you'll feel way more confident about the next time you approach any stock valuation. So, if that all sounds good to you, I hope you'll take the time to hit the like button. You guys are great. Here we go. For the sake of this video, I just plan to look at these valuations using PayPal's earnings. When doing a full valuation for a stock before actually investing, I will try to, and would recommend you, look at it from as many angles as possible, as many as make sense. There is no exact right answer here for what this stock should be worth today. So the more ways that you can look at it, the better, more comprehensive understanding you'll have and confidence you'll have in your ultimate decision as to whether or not to invest. Now for PayPal's case, it won't be as easy as going to any market aggregation site and pulling their reported earnings. When you listen to their calls or look at their reports, they've tried to clean up their numbers for you by separating out the PayPal part of their business and the old eBay part of their business. What was being supported and driven by eBay isn't as useful in helping us determine how well the independent ex-eBay PayPal service has been able to grow in the past so that we can gauge best what's reasonable to expect for the future. Now, to get this information, you'd have to dig through their old 10-Ks filed with the SEC. Well, I already did that for you here. Specifically, I looked at their 2021, 2018, and 2015 10-Ks to get the following breakdown of PayPal's ex-eBay revenue. This first line here is the total revenue that you might find on any number of financial data aggregation sites or used in other people's analyses here on YouTube or wherever. This second line, however, are the more relevant to me as an investor ex-eBay figures pulled from their 10-Ks. The third line here is the growth rate of their ex-eBay revenue. I've highlighted their highest growth rate over this period in green and their lowest in red. And you'll see that throughout here anytime we get to historical growth rates or valuation metrics. The highs will be green, the lows will be red, just to make it easier for you to sift through all this data once we get this full thing populated. So as you can see, despite disappointments in the fourth quarter of this year, the company has proved to be very consistent, like surprisingly so, at growing this top line figure. Now, management lowered their growth target for next year down to 15 to 17% due to the very inflated early quarters of 2021 that were still being boosted by pandemic growth. As you can see, 15 or 17% they're both lower than their historical average. It's even lower than their worst growth year ever at 19%. But think about it this way. Even if they only realized 15% ex-eBay revenue growth in 2022, their 3-year average growth rate at that point would still be an impressive 22%. It's not uncommon for growing businesses to experience a low growth year or years on a relative percentage basis immediately after periods of unprecedented growth, as PayPal experienced in 2020 and early 2021. You see that discrepancy even more when we expand our analysis here to include PayPal's earnings per share and how that has grown over the years. Although this number does not factor for the eBay adjustment that I made earlier, it will better account for the impact share buybacks and stock-based compensation have on individual shareholders like you and me. On that note, you'll see headlines that they're doing buybacks, and in general, that's a bullish sign for any individual stock. But they also do a ton of stock-based compensation, which is fine with me. But it's just important to note that they, for the most part, have been offsetting each other with only a minimal reduction to the total shares outstanding over the years. This does bring to mind one quick aside I failed to mention earlier in the video, which I view as both a positive and a negative. And that is the ownership of those people at the top, management and other insiders. You know, the ones who are most intimately familiar with PayPal's true long-term prospects. I especially love the way Simply Wall Street breaks insider information down for me. So we'll pull that up here. You see, insiders have been buying. That's a great sign. These are some of the directors, and they've been buying in decent quantities. But individual ownership by any of the directors, and especially management, is relatively low, especially considering how much stock-based compensation they've been awarded over the years. Anyway, just some more variables to keep in mind. All right, back to the valuation table that we were building here. So again, here with the EPS, we see a similar theme of impressive average annualized growth over the years. When we compare those EPS figures to the price of PayPal stock over the years, we see a pretty consistently elevated, relative to the industry, PE ratio. The industry average tends to be much closer to the valuation PayPal is trading at today. So now we're getting a better feel for the information we'll need to construct a thoughtful discounted future earnings analysis. But before we jump into that, let's go ahead and throw in one more valuation metric here. Let's look at PayPal's price to sales over the years. You can see here their sales per share growth over the years, which is going to differ from revenue growth for several reasons, not the least of which is the changing number of shares outstanding, which again for PayPal is minimal, but still present and still affects this ultimate value. Notice how PayPal's current valuation metrics are around the stock's historical 2016 low. Now, I'd also, before we fill in our earnings analysis, like to better understand the valuations placed upon comparable companies. Now, as you know, there's nobody exactly like PayPal, so that makes this a little difficult. It's not like being able to compare JP Morgan to Bank of America or Coca-Cola to Pepsi. And before someone freaks out on me in the comments, I know those aren't the exact same either, but I hope you see what I mean here. Anyway, we'll do our best. In this scenario, I like to look kind of at both sides. Companies that might be a decent model for what to expect a reasonable PayPal valuation to look like in the future, and companies that are younger with potentially even greater growth prospects at this point. For the older, more stable comps, we can look at Visa and MasterCard. Yes, they have different business models than PayPal, but they're in the same industry, and so should be impacted by a similar valuation schema. And when you study their historical revenue growth, it's comparable to PayPal's, in that they're pretty consistent. Take a look. Here's that same year-over-year data from 2015 through the end of 2021 for both Visa and MasterCard, tickers V and MA respectively. Notice a similar healthy revenue growth consistency. Now, for them, the impact of the pandemic was the opposite as it was for PayPal. They were both hurt where PayPal was boosted. But from a consistency standpoint, from that average annual growth rate perspective, and you'll see this all wash out in the analyst and company projections, which we'll look at in a bit, which show Visa and MasterCard making up growth ground relative to their recent comp periods over the last couple of years, versus how PayPal is preparing for a period of worse growth from a percentage perspective than ever, as we already discussed. But anyway, despite the similarity in steady top-line increases, both Visa and MasterCard have historically grown at a rate that is around half that of PayPal. The situation for those companies is a bit improved when you factor in their significant share repurchases over the years, resulting in a much more impressive earnings per share growth rate, but still shy of PayPal's. And historically, as you might expect, considering this side-by-side comparison, PayPal has, historically at least, boasted a much higher price-to-earnings ratio. So here's their full charts of the data I collected for us on this, of these three companies side by side. In the boxes on the right, you can see the 3-year and long-term averages for all their growth rates and valuation metrics, as well as where their current ratio stands at the time of this recording. As for our younger high-growth comps, I already said that SoFi is out due to the fact that it's still loss-making, rendering it a very difficult comp. That leaves Square, or Block, ticker SQ. Now, these companies have some things in common with one another. Specifically, they're directly competing in the peer-to-peer and buy now, pay later markets. Yet Block still has a way to go to prove itself, and thus, for now at least, carries the valuation metrics of a much riskier company. So here's all that same information for Block. The company's top line saw the same pandemic boost as did PayPal, but on a per share basis, Block continues to issue more and more shares every year, which keeps diluting the actual value of all that revenue to the individual shareholders. On the surface, Block's valuation here appears to be one of those that I personally would just struggle to get behind anyway. But that being said, I haven't done a deep dive on Block yet. I know they're doing some innovative things, and maybe we would be able to find a way to map out and even maybe justify their current crazy elevated value based on some relatively tangible potential. I don't know. But that's beside the point for our PayPal valuation anyway. Okay, so now that we have a lot of information about PayPal's history, the current valuation of some industry comps, and the historic valuations of those companies, it should be much easier for us to come up with growth rates and terminal PE multiples for our discounted future earnings analysis. So if you'll remember from my Meta and Alibaba analyses, I'm looking out over the next 7 years for this. I'm not sure I can hope to realistically project any further than that. So for my base case scenario here, I'm thinking that PayPal's next 7 years look like Visa's last 7, right? They're starting to mature, finding it more difficult to pivot, facing increased competition / increased pressure to cut them out as the middleman. So I'll steal Visa's long-term historical average growth rate of 16% and plug that in for my conservative base case growth rate for PayPal. As for the terminal multiple, again, I always like to err on the side of being too conservative, but still, while trying to be realistic. I'm going to use the lowest PE ratio experienced by Visa or MasterCard over the last 8 years, rounded down, which was 27. For my conservative bull case here, I'm thinking PayPal once again reasserts itself as an innovator and leader in the fintech space by carefully expanding their exposure even more into crypto, but even more so, I'm picturing their successful expansion into the lucrative brokerage world, as we discussed earlier, and them being able to successfully blend all of that into their already popular digital wallet. With those assumptions, I don't think it's crazy to project them continuing to grow their revenue as consistently as they have over the last 8 years. So I'll plug 22% into our calculations here, just under PayPal's historical figures. And then I'll give it a terminal multiple between where it and Visa are today. Let's say 32. Again, based on what I'm seeing here, that's actually probably on the conservative side, but I'm okay with that. As long as I do that with all my analyses, I'll still be able to enter the best opportunities, but will be more psychologically prepared for any downside realities that come to bear. Okay, and finally for the bear case, at least as they're structured today, there's not really a chance of them going bankrupt or out of business or anything like that. So I won't need to factor for some sort of extreme bear scenario like we did last time. But I want to be hard on them here and say that perhaps the entire financial industry right now is just a bit overvalued and that they all come down closer to where the S&P 500 average is today. So I'll put its terminal multiple at 18. That's still not as low as some of the older dying companies in the industry, but it's obviously lower than PayPal has ever experienced, or that Visa and MasterCard has experienced in their recent history at least. As for the growth rate, I'm picturing a world where none of their new ideas work out. Their M&A activity continues to be on par with their Pinterest courtship faux pas, and more companies begin to find ways to cut PayPal out, including perhaps these old giants, Visa and MasterCard, who control way more transaction volume than does PayPal at present. Visa in 2021, for example, processed $13 trillion of transaction volume compared to PayPal's 1.25 trillion. With all that, I'll say their EPS growth is really hindered and drops down to 14% per year over the next 7 years. Only slightly less than their low-end estimate for their top-line growth during this 2022 recovery year. Okay, so when we plug all that in and then enter their current trailing 12-month EPS of 3.52, here's what it looks like. A conservative high-end estimate of $232.52 after we apply that 10% present value discount back to today to determine what it's worth to me, and a low end of 81.36, which actually, when I was studying the technicals, which I don't think we should cover in this video, there's too much information here already, but that, coincidentally enough, bumps right up against an important support line from a technical perspective in the mid-80s per share. Anyway, I feel much less conviction as far as which way this will lean than I did in previous videos, so I smoothed out my probabilities a bit. If I'm being honest, I was tempted to lower the bear case probability and favor the base or even bull case a bit more, but right or wrong, for now, I just left it like this, which leaves me with a what it's worth to me value of $147.39. But we're not done yet. I threw one more layer of analysis on here for you. Again, if you appreciate all this, please take the time to hit the like button and introduce yourself in the comments. I would love to get to know you better. Okay, so this is just a basic multiples analysis where we will apply various real-life multiples to PayPal's earnings today to see what the implied valuation would be and the resultant upside potential or downside risk. Here's what I mean. PayPal's long-term average historical PE ratio has been 48.88. If we apply that to its earnings today, that implies a fair value of $172.07, which would be a 71.69% potential upside. You see what we're doing? It's easy and kind of fun to play around with. if we take Visa and MasterCard's current PE ratios of 35.48 and 37.46, we get an implied value of $125 and $132 respectively. But let's keep going. Let's look at all these companies' future values based on future earnings projections and how they're being valued on that relative basis today. Here they are. I've plugged in the estimates for all 4 companies' EPS and revenue over the next few years. Note how the growth rates are projected to get back closer to what they have been historically. And you should note that these ratios here are their forward multiples. That is, they're based on today's price, but future earnings projections. So when comparing PayPal's forward 2024 earnings multiple of 13.9, it makes sense to compare that to Visa's 2024 forward multiple of 20.26 and MasterCard's of 20.29. You with me? If not, feel free to pause this video to study it a bit longer and definitely hit me up in the comments with any questions. Now, for our multiples analysis, I'm not going to use block here because their earnings projections are kind of, from a percentage perspective, kind of all over the place. Whereas Visa, MasterCard, and PayPal's estimates are within a pretty tight band. Okay, so back to our multiples analysis table. If we valued PayPal today based on the 2022 forward multiple everyone is giving Visa, the stock would be worth $130, implying a 30% upside. I went ahead and filled in the rest of this chart for you in the same way. And when you take the average of all these implied values, you end up with a value that, surprisingly enough to me, was really close to our discounted future earnings figure, $143 versus $147. Whew, that was a lot. I really hope you found value in it. If this video does well, people sharing, liking, commenting, etc., I would love to continue to make more. Let me know if they're helping. Let me know what you'd like to see. And feel free to explore those links in the description to check out some of the deals I've been able to work out for you with some of my favorite analysis tools. Now, if you haven't seen the entertaining and highly informative video I did on real inflation, I highly recommend you check it out. It's this one right here. And if you're interested in those other individual stock analyses I've done that I mentioned throughout this video, I just put together this playlist for you. I really appreciate you. Until next time, take care.